In this episode, I'm going to be taking you through trades that will get you funded. I'm also going to be walking you through why you're staying in drawdown and how you're not letting your winning trades actually play out. I've had a lot of questions recently, and these are from traders that trade a variety of different systems. I noticed a common problem, and it goes back to really simple basics when it comes to price action, which is allowing the higher time frame narrative to play out and also allowing your winning trades to play out as well. A lot of traders don't struggle to get involved in winning positions. What happens is they cap themselves short. So they add to losing positions and then they don't let their winning positions actually play out. I'll show you that on some simple price action. This is going to be so valuable for you. I almost guarantee that your next level of success is right under your nose. So I've got two pairs here for you. I'm going to demonstrate exactly what I'm talking about. If you want to avoid being in drawdown for long periods of time, and this is off of a lot of data, when people have sent me these journals, it's so black and white. I'm literally zooming out on how I view the markets, looking at the high time frame narrative, and I'm gobsmacked as to why they're closing these positions. I don't think you need to do something drastically different. I think you need to understand exactly how to manage them better, but that's just one part. So let me show you. So I've got euro dollar here. We're going to keep this really simple. High time frame narrative. We have this liquidity point here, and we have price making these gaps towards that high. So when you see price gapping towards a significant high, you usually see this first high be taken out, which is here. We'll create another section, and then we'll take out this high, which will get closer for us to fill this gap. And when we fill the gap, we will get the masses caught on the wrong side of the market and the bigger players step in. That's literally Falcon 101. We actually don't trade patterns how you'd think we trade patterns. So patterns are just one element to it, but it's not the catalyst that moves the market. For example, this is not a perfect three touch. People from the outside, they might think, do you trade three touches? Again, they're just very misinformed and don't actually understand how we trade. So if you look here, 1, 2, 3, why would we trade there? It's just bullish price action. Of course, there's other criterias. So these are actually perfect, by the way. I'm giving you a little bit of juice here, but these are perfect when they're not perfect. So I prefer it if the three touch doesn't make the three touch. This is significant. So let me go into slightly lower time frames, but high time frame narrative. So are you positioned well? That's a question that regardless of how you trade, you should be asking yourselves. So if you're positioned well in the market, it's half the battle. So as you can see here, we get a nice drive down. Again, we were actually looking for some longs in here if we got the criteria met, and it was half baked. It didn't even get close. So again, catching the rookies on the wrong side of the market here. And then what do we have? We get a nice push lower. So again, all this essentially was volume accumulation, first initiation of that move, and we leave a footprint in the market. We sell off, we come back, we retest the area, we sell off, and we do the same thing that you can start to see on these lower time frames. So why is this important? Let's say your system is predicated on you taking 2 to 1. So I got a variety of these questions. It was 2 to 1s, 3 to 1s, 4 to 1s. There was a few other things, but essentially the question was, am I capping my trades too short? Can you have a look? So I took a look at them. The trades themselves are actually fine. I don't think traders have an issue in getting involved in winning positions. I think they don't understand the bigger picture, close positions due to anxiety or feeling like they just need to get out of the market as quick as possible. And then they just get out and that's it. And then they look back and think, oh, that ran for 16%. I'm not saying this from a position of that you should obsess over returns. I think the opposite. But you should be looking at your trades and thinking, yeah, there might be something in there. What if I'm just conveniently leaving that on the table and getting out just because it feels good to get out of the market? You've got to look at the numbers and look at your own data. So I recommend you look over the last 3 months minimum. So if we look at this position, look at how convenient it is. We create the liquidity. You can see we've got this, and again, this is just simple continuation. We sell off. There was a short-term trade in there, would have got out roughly around here. We then come back in. This was the area of forecast. This was a position that I took. This was an AFT entry, which is more of an advanced entry in how we take it on the lower time frames down to the 15 and the 5. And again, this is what I'm talking about. It was really interesting because someone who's trading different systems sent me a similar trade where they got involved roughly around here, but they closed it from memory around, I think it was here. So yeah, so it would have been the 4 to 1 one. If I go lower, you'll see what I'm talking about. So the next inflection point, this was clearly, let's say, target area for them. Fair enough, that makes sense. They're looking for a 4 to 1, sold off, they took it. That's okay. The problem is that when you don't look at the higher time frame narrative and realize, if you just go to the 4 hour, you can see that price action has been buying. these trades around this area, you're positioned well. This is the point I'm making. You're positioned in a way that you're likely to see much bigger prices actually sell off. So there's going to be more drives likely to start to see the market trending a little bit. So you're taking, let's say, a 2-to-1, 3-to-1, or a 4-to-1 in the region where you could be banking 7, 8 plus, or at least targeting the 4-hour low. So if we look at the 4-hour low, what have we got? Let's extend that out. You're walking away with, even if you set it as take profit, right, and you didn't want to trail your stop, you want it to be mechanical in that sense, you're looking at a 10-to-1. How much is that worth to you? You've got to ask yourself, how many of these trades have you just cut short by doing so? And if you're saying, well, Mark, look, you know, I'm 100% mechanical, that's fine. The irony is, most people that tell you that they're 100% mechanical are making discretionary decisions. Now, I know you don't like that word, but it's the reality, it's the truth. The top traders in the world use discretion. There's always a human involved. Now, you can look at it as, right, you just keep taking that trade, keep taking that trade. What you got to ask yourself is this: are you going to do that when you've got 500k, 600k, a million on account? You're probably not, which is you'll find conveniently when the accounts get bigger, the stops get wider. Why do you think that is? Is because intuitively you know going as tight as possible is riskier and you're happy to do it on small accounts, but as it gets bigger you become more cautious, right? Why? It's because it's intuition. You instinctively apply common sense and think, with slippage, crashes, this is probably not a good idea, so I'm just going to be slightly more cautious and sensible in these areas. So again, as you get more money, you will start to be slightly more cautious, but for the right reason, for a logical reason, because you don't want to be funded and unfunded constantly. You want to be doing this for the long haul. So again, I encourage you to zoom out, look at the bigger picture, and think about it like this. Imagine if you done this twice a month and there was an extra 2 or 3%. I'm not talking about massive returns, just 2 or 3% on the table. Say that's 6%. What's the compound effect of that 6% per month on average over a year? If you're someone who's sitting in drawdown for most of the year, I've not told you to do anything different. Take exactly the same trades. Don't take less trades, don't take more trades. Take the same trades that you're in. I don't think traders have an issue of getting involved in winning positions. I think traders have an issue in holding those. That's why they add to their losing positions and they can't let their winners run. And this has been prevalent in trading for years. Now let's go to the next position. This was a missed position for myself, but look at what we're looking at. The systematics of it is that on the 1 hour chart here, as you can see, we've got footprint in the market. So label this as your footprint. So here we're just going to call this MF for short. Here's your footprint, same thing, same systematic. We've got a footprint in the market. What do? We create a gap. This high gets taken out, we create another gap, we call it a near miss. Eventually it wicks out, there's a riskier entry in there, and there's an entry within here. So imagine I applied that same logic to my system and I capped it at 2-to-1 or 3-to-1. There might be a reason for it at this, let's say for example you targeted this low or this wick here for roughly 2.8, you was happy to get out. Well, let's say it was literally a 2-to-1. All you have to do is look at again, go to the 4 hour, look at the low, look at the actual structure. Do we have room to trend in the first place? Well, if you understood price action, you would see this sequence is nice. You would see that we're aiming towards this low in the first place. You would look at the DXY and say, does it make sense? If DXY is going higher, this is going lower. So again, you just apply really simple logic, at least to that low, right? So you're talking about 5.5 and then to that low, 6.8. Even if you set that as a take profit, again, the difference, 2 or 3%, you got 6.78. Roughly 7%. How much is that worth to you, that extra 3 or 4%? I'm not saying do anything different apart from think about your management, right? So that's one element. Now you might be saying, right, that's all well and good because that's in hindsight. Well, I'll give you an understanding. Let's take a look at pound dollar. We'll apply the same logic. High time frame narrative. You can see we're positioned well on the weekly time frame, right? Tiny little consolidation point there. You've got a nice weekly complete retracement of that weekly candle. Daily sells off. We leave some footprints in the market. If we go to the 4 hour, you can see right here, and how we know this to be true. Again, I'm giving a bit too much here, but you can see that sharp move. What have we got? Volume building. So what do we have here? Entry 1, entry 2. So we're either going to look for an entry here if it meets the criteria, or we're going to wait for price to tap into this area, pull back in, and then we'll take our entries, AFT entries and typical Falcon entries and so on. So it's the same thing. We're looking for it over and over again. What happens? Again, it fills a gap. It gets slightly higher to take out this, which it does. And then what would this third one do? Take out that high. And when it gets close to this region, you usually see this either can be as in the form of a wick or just a bit of a quick price action, retracement, and then we go. Then we look at the DXY positioning. The DXY is going higher, pound dollar is positioned for us to take a sell. Imagine I then take a sell around here and I close it for whatever reason in a really blown up zoomed in time frame around here for a 3-to-1 when I was 15. Do you understand my point now? It's not about obsessing over returns. It's about, if you're constantly doing that, it's all well and good, and I know people that do take these type of 2-to-1s, 3-to-1s, and it does work for them. However, what comes with the territory? What comes with the territory is sometimes really painful periods of drawdown. If you knew how to just look at the bigger picture better, you would know in certain type of environments you can hold these positions and basically squeeze so much more out of the trade, and that within itself will massively increase your level of staying funded, getting funded, and putting yourself in a position. These trades, hand down, these are our bread and butter trades that will get you funded and stay funded. I hope this gives you something to think about. If you want more technical lessons, please feel free to leave us any comments about this. Again, you are so much closer towards your next level than what you would think, and I guarantee you it's right under your nose.